Hello and welcome to the ETF Daily channel. Today we are going to be covering UK wage growth, jobless numbers, oil prices and other items. Looking at today's market prices, the FTSE 100 closed 78 basis points below the previous closing price to £8,205.98. The S&P 500 and the Nasdaq index closed 45 basis points and 84 basis points above the previous closing price to $5,495.52 and $17,025.88 respectively. So, our first piece of news comes from Office for National Statistics, which have reported the wage growth, excluding bonuses, to have slowed to 5.1% year-on-year over the 3 months to July, marking it the lowest level since the quarter to July 2022, while unemployment rate dropped to its lowest level in 6 months to 4.1%. This data suggests an ongoing shift in the labour market as economic uncertainty and inflationary pressures continue to shape the outlook. While the wage slowdown may signal some relief for the Bank of England, which has been grappling with inflation control, it also points to a labour market gradually loosening, meaning there are less vacancies than unemployed workers. The number of job vacancies also fell by 42,000 between June and August, leaving the total at 857,000 vacancies. This represents the 26th consecutive quarterly decline, a clear indicator of cooling demand from employers. Analysts believe that although the slowing in wage growth would give the Bank of England to cut interest rates, Bank of England is most likely to pause interest rate cuts for September meeting before implementing another 25 basis point rate cut in November 2024. Moving on, major oil companies have faced decline in their stock prices, with the Vanguard Energy Index Fund ETF falling by 216 basis points. This was due to oil prices sinking, with Brent crude oil trading at $68.58 as markets were closing in London. The movement in price came after OPEC lowered its demand forecast for the second time in 2 months. OPEC now expects demand to grow by about 2 million barrels per day in 2024, which is 80,000 barrels per day lower than previously forecasted. The group of oil producers also see demand growth of 1.7 million barrels per day next year, about 40,000 barrels per day lower than originally anticipated. The group had cut its demand outlook in August because of slowing in consumption from the world's biggest importer of crude oil, China. According to the executive director of energy futures at Mizuho Securities, China's crude imports declined about 3% in 2024. The next item comes from the big banks in the US, which shared their valuation due to expectations on a pessimistic outlook on the industry's expenses and revenue. JP Morgan's president and chief operating officer, Daniel Pinto, said analysts were too optimistic in projecting next year's expenses and net interest income. He further added the current net interest income estimate of $89.5 billion is not very reasonable given interest rate expectations. This was further echoed by the CEO of Goldman Sachs, David Solomon, suggesting his company's trading revenue is on track to drop 10% in the third quarter. The forecasts were also grim for the smaller firms, as Ali Financials said auto delinquencies and net charge-offs were up more than expected. All of this led to the KBW Bank Index to fall by 184 basis points at close, despite the Federal Reserve confirming that it will cut higher proposed capital requirements. Lastly, the Nasdaq moved higher as tech firms had a strong opening despite Apple dipping in value. Yesterday, Apple unveiled its flagship product, the new iPhone 16 and 16 Pro. However, impressions of the new iPhone were lackluster as there were only minor changes compared to its older version, the iPhone 15. Also, hours after the unveiling, its competitor Huawei revealed its latest phone, the Mate XT, which received 3.6 million orders in China. Also, the dip in Apple's valuation could be explained by the loss in its court fight over a €13 billion or $14.4 billion Irish tax. This has been an ongoing case, which stems back to 2014 when the European Commission opened an investigation into Apple's tax payments in Ireland. Okay, that's all for today's episode. Don't forget to subscribe and like the video. I'll see you for the Wednesday 11th September episode. Thank you for listening.